All right, it's going to be one hot week, and you're looking at a live map of potential record highs this week across the country. With these hotter temperatures, Americans are set to crank up their air conditioners. That, of course, puts extra strain on the electrical grid, and it puts natural gas in the spotlight because most of them are functioning with natural gas. So joining me now is Tortoise Capital Senior Portfolio Manager Brian Kessens. He manages $11 billion. And NG, you are saying go for the companies that are focused on natural gas because of what? A hot summer.
Yeah, for sure. We definitely see a hot summer that should generally be helpful for natural gas markets. I think a lot of times people don't realize, over time, that price for natural gas is driven by a lot of things, but at the end of the day, it's driven by seasonality. When it's really cold in the winter, natural gas prices do well. When it's really hot in the summer, natural gas prices tend to do well.
I would imagine. And so your picks are Cheniere, you like EQT, and you like a company called Targa. So are they all doing the same thing, or give me a reason to have three of the same type of company in one portfolio?
Yeah, so, they're all involved in the natural gas markets for sure, but they're all doing something a little bit unique and benefiting in different ways. EQT is a very large U.S. natural gas producer. They have some of the lowest cost reserves, mostly in the Marcellus Basin. We expect their production just to continue to grow over time, and they'll benefit certainly from higher natural gas prices. Cheniere Energy, ticker LNG, very apropos. They are the largest LNG exporter in the U.S., so they're benefiting not necessarily from U.S. demand, but from global demand for natural gas continuing to grow. And then Targa, they benefit because they're transporting really low-cost natural gas from the Permian Basin toward the Gulf Coast. And we expect frankly, all three companies just to continue to benefit from the natural gas thematic.
I do find it interesting that since the war began, February 28th, that natural gas is still about 11% higher than it was before the war. And when you look at West Texas Intermediate, it's come way down. I think it's now barely just above 5%, 5% above where it was. So I think your theory is starting to play out correctly, Brian. What else do you like? Is there another sector beyond energy that you think has an opportunity to run?
Yeah, within energy in and of itself, not necessarily tied to natural gas, but going to where you were at broader with on the liquid side, on gasoline, diesel, and jet fuel, the refiners, the U.S. refiners in particular, we expect to benefit quite a bit. Crude oil prices have come down, which just means their input costs are a lot lower, but we're in summer driving season, so demand for those gasoline, diesel, and jet fuel are going to continue to grow, not only in the U.S., but globally as well. Then, if anything, some of the attacks that Ukraine has on Russia are impacting global refined product supply.
Great to have you, Brian.